All right, so after some electrical issues, first with my lights that show so you can actually see me in the video, and then with my office outlets, I became an amateur electrician. It took me a while, but we finally figured out what to do thanks to YouTube and how to manuals. But we got the video up and running tonight, so not a whole lot from a market standpoint in terms of movement, but significance in terms of where we're at and what we can expect to see. So I'm going to break down what that significance is and then look for a trade idea on a stock that may be starting to bounce up again after a pullback. It's a similar theme that we've seen here lately. So let's go ahead and get started. Today is Wednesday, June the 26th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. So as you can see, I've got Fibonacci fans drawn on and retracement levels drawn on the intermediate run that we're currently on here. So just like we had here, and just like we hit a crossing over at this point that we bounced off of the last intermediate run, this is obviously a much shorter intermediate run that we've had so far. But the short-term sentiment is relatively bearish. Now with the near-term line dropping deep into the reversal zone and the momentum line staying down there 3 days now. But as you can see, all it's produced in terms of pullback is simply a 23% pullback towards the previous near-term high point, which is the peak, the last blue peak. So we haven't even crossed below. Like obviously we haven't crossed below the previous near-term low point. But we also haven't even crossed below the near-term high that preceded it. So that is actually still holding for support. And then, like I said, you have this combination of the 23% Fibonacci retracement crossing the 38% fan right now, today, with this pullback. In class yesterday, we talked about this idea of one more day of downside. I might have talked about it in Market Outlook too. But one more day of downside to get to that line, and that's what we got today. Not a whole lot of downside. We're not significantly bearish here, except for on the short-term sentiment, and the intermediate line still easily in the upper reversal zone. So we'll see if that leads to now a bounce off of this level heading into tomorrow. Remember, we still have dark green shading because we're still above 50 and bullish. Even though it's falling, it's above 80, right? If it were falling below 80, then we'd be light pink, like this. So we're still dark pink shading, and we have a green line. And if you look, we'll look at here the three green arrows in a minute, but we're still pretty bullish on that too. Let's take a look at the other indexes first on the market forecast. You can see same exact pattern on the Dow. If you take a look at the NASDAQ, its short-term sentiment's not as bearish because we were actually up today on the NASDAQ composite. And then finally, the Russell 2000 was only down about 0.2%, was actually outperforming for parts of the day today. You can see it pulled into that 50% retracement zone. It is now got a red line. We don't have dark pink shading, we have light pink shading. But we have a red line there. So breaking below 1500, which would be getting through the Fibonacci retracement zone, would be like the complete trend reversal, which would lead to weakness on the other indexes too. So you can see the difference. The Russell's a lot more bearish because it's got the light pink shading with the red line. See, we never did get the green line to combine with that dark green shading. So we're still kind of in this bearish mode. That was unlike the other indexes. Even the NASDAQ composite was able to get that combination to reverse this pullback that the Russell 2000 hasn't. So this is a really important end of the week now, heading into Thursday and Friday, of course, with the risk events due up at the end of the week. But this is a really important end of the week to see whether or not this support holds or not. Because if it doesn't, as we saw, we already have this bearish divergence that would target the 38% Fibonacci retracement because it happens to be the low point that corresponds to the low in between the two divergent high points. All right, so that would be your target, and of course a break below that would be the trend reversal. If we were to maintain bearishness here, through some up and down choppiness, then what the fans tell us is that time frame, today was the time frame for a pullback to the 23% level. The time frame for this 38% level, if not today, would be more towards the July 4th weekend, so through the end of next week. So we might get some ups and downs before getting down to that point by the end of next week. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that red subscribe button that pops out. Also, you can also click the red subscribe button right below the video. That notifies you when these videos are posted. Click the thumbs up icon down below the video too. That tells me two things. Number one, you got something out of the video today, and number two, you want us to do it again tomorrow. Quick, very easy way to give us feedback. With that, we check out every day, so make sure you can do that right now even while we're talking. Also down below, comment. What did you get out of the video today? I'd love to hear any thoughts or any new ideas that you got. Join our daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe. Very easy way to do that. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook community that we've created on Facebook. All right, we also invite you to subscribe to our website, marketscholars.com. You can do it for free here. In fact, that's going to be the only way that you can get these full versions of the video, Market Outlook video, here in the near future, is if you are subscribed to our site. Again, very easy way to do that. Click here. The link to the full videos will also be sent out to people subscribed to our email list. So when you subscribe to our site, you can also subscribe to our list at the same time. In fact, the box is already checked off for you. We also invite you to engage with us on social media. We make it really easy here with today's Market Outlook tweet and Facebook post. Just click on this heart. That will like today's tweet. Hit like button there. And then click on this image that takes you to your Facebook page. Again, the more you engage with us on those particular platforms, the more they will continue to push you all of the content that we put out there on those platforms, among all the other accounts that you follow on your timelines. All right, back to the charts, especially this weekly chart here. You can see the weakness we're having this week after a pretty strong 3 weeks here with a small, moderate week in between. So again, when you talk about, when people tell you how bearish this little pullback has been, remember not even 23% retracement, also keep in mind how bullish we were going in. I mean, this should put into some context what it looks like. If you look at the Hakinyashi candlesticks, again, we're not... we'd have to get down below 28.88, and we're at 29.13. So we're still not even to the point. Now, granted, we're not up to new highs, so we might not get a higher upper shadow. But if we don't get a lower shadow either, we still end up with this bullish candle. And this is bullish candle number 3 that we typically get around probably 4 to 13, right? If you're looking for a 1 to 3 month intermediate rally, probably more towards at the 13 number. Probably not as long as this one was, but more kind of like what we saw here off of this intermediate pullback that we had. This intermediate pullback was a little bit longer, but again, it looks very similar to other intermediate pullbacks that we had over here that led to multi-month intermediate runs coming out of it. Let's take a look now at the 3 green arrow chart. So we talked about that briefly. As I said, here we had this pullback. It doesn't even produce 1 red arrow. So again, how bearish can we be when we don't even have 1 red arrow, much less 3? And then you can see on the we're close on the right here. We're close on the moving the MACD. The MACD is below its moving average, so that's not good. I mean, that's where you're going to get the red arrows. We already had the surge, and now you can just grind up and down above and below its moving average this entire time. So. We'll see how that does. Today we closed below the 8-day moving average. Well, yesterday and today we closed below the 8-day moving average, but we're easily still above the 17-day. And there's stages to these pullbacks. Closing below the 8 is one, or trading below the 8 is one. Trading below the 17 is another. And then, of course, getting below the 30 is your final stage, which usually occurs after the MACD has been grinding for a while after that initial surge. Now let's take a look at the intraday charts, and again you can see here's the Hakinyashi Open for SPY, right where last week's low point is, so we're still easily above that, and we're sitting right at this gap. We're flirting with filling in this gap. In fact, we've kind of gone down a little bit. This line where I'm at 290.96, and we're down about 50 cents below that. So we're flirting with kind of filling in that gap, which would be more bearish, and as well as getting below this old high point and filling in and getting towards the low. But even if we do fill that in, it's getting below this level, 287.50. That will be your significant reversal in the short term. Until then, we're just kind of flirting, right? This we're the end of the close today. We've been flirting here. If you look at the volume and the trading range here, which again, you saw yesterday's trading range is a little bit bigger. Got all the way up to 3 points, a little bit bigger than the average. Well, today we're right back to well below the average, 2 points with 51 million shares trading hands. Outside of yesterday, that's been the case for most of this pullback. 51 shares is way down here. Just under 2 points is way down here as well. These are both already low numbers, and they're still coming down. And then 2 points is below. 2.9 points is 1%. So again, we're not really getting these deep, big moves up or down for that matter. And if you take a look at the volatility on SPY yesterday, we came close to a 1% move. Right there. Came really, really close to 1% move, but still not even crossing through that threshold even. So, again, keep that in mind when you're talking about, how volatile this pullback has been. It obviously has not been very volatile at all. And speaking of volatility, we'll look at the VIX. And the VIX is up, relatively speaking. It's elevated. It's elevated towards the top end of this neutral zone, this 95% mark. We've been here before, and then we were grinding through the neutral zone to the bottom end. We'll see if we get that similar pattern here. If we bounce off these short-term support levels and continue this bullish intermediate run that we're on, then we'll see a similar pattern developing. Again, we're not, we're also kind of at the same levels we were over here too in earlier June. We're not up into these levels, which would be obviously more bearish. Neither are we surging in volatility, right? Because that's when you surge through these levels to this 1.5% level, 105% level, excuse me. That's when, okay, we're going to be bearish for a while. That's the initial surge. We're going to be bearish. We're still not even through into the bearish territory yet, much less surging to these high levels. So, this is very typical. We've seen this kind of pattern before where, you have, the surge, you make another run into the bearish territory before breaking down below 90% and staying down there. We saw that earlier this year. We saw that last year as well in this area. So we're still kind of in that mode right now. All right, before we go to the second half of our video where we kind of focus on intermarket relationships and what's driving the price action as well as a trade example for the day, we'll summarize the technical outlook here and get your vote and see what you think. So we continue with this short-term weakness, which as of right now has not shown to be anything more than that, just a short-term weakness in the form of a near-term pullback towards Fibonacci retracement. The timing has been right with using multiple Fibonacci retracement types lining up together for support bounce here in this area going forward. So we'll see. Obviously, we have a big event risk coming up this weekend, but the technical environment is giving us the environment where we can bounce out of that really, really easy. And of course, if we break through support, then things change. But as we always talk about here, you expect support or resistance to hold until it doesn't. And that's the case now. We're at support. We expect it to hold until it doesn't. So the environment is ripe for support bounce to maintain this current intermediate trend. And we'll see if that ends up being the case through this weekend and into early next week, and eventually into the earnings season coming up in July. So what do you think? Do you agree or disagree with that? Click that link that's popping out right there. It opens up a poll, and now you can vote with either agree or disagree. If you click disagree, comment down below on what you're seeing that would suggest otherwise, either that you're a lot more bullish or a lot more bearish than what we're showing here. Share with the rest of the market scholars community that watches these videos day in and day out. All right, now let's talk about what's driving the price action here. And you can see, of course, it's kind of a weak dollar. This is the last 2 weeks. It's been a story of crude oil and gold leading the way to the upside. Interestingly enough, during this weakness in stocks, which you see with the black line, from the high point in stocks, crude oil is actually higher. So there's been a little bit of divergence. Those have been two asset classes that have been highly correlated with each other. A little bit of a divergence here going on to the upside with crude oil, obviously with issues, geopolitical issues in the Middle East impacting. Usually, when you see these two kind of move up together like this without a significant decline in the dollar, it usually has to do with geopolitical tensions in the Middle East. Interestingly enough, emerging markets had been underperforming. You can see they've been outperforming now. So they've been actually holding up pretty well, at least especially compared to U.S. stocks. In fact, they were almost up 1% today versus U.S. stocks, which were obviously down. And bonds were down today too. And that's been a big story. You can see when you look at the chart for the 10-year yield, that's a pretty significant bounce. Now, granted, we're extremely oversold, and we're still just right around that 2% level. And if you look at other charts here, we're above that green line. That's a good positive step that we haven't had yet. We had briefly there, we turned right back down. We had it up here, and we had a brief little run. This is the kind of move I'm expecting that we'll get now, probably up into this 2.4% area, maybe even flirt with the top end of this cloud by the time we get there, before pulling back. So nice little bullish cross to get above the green line here. That's a bullish crossover from a Bollinger Band standpoint. You can see we still got lots of room to work with here. We're just barely coming off the low, still easily in the lower half of the chart. And then when you look at the DMI, you can also see the same thing. Still got some room to work with here, right? We are just barely crossing back down below 40 on the orange line, but definitely not below 20. And the blue line, which was below 20, is just barely crossing back up above. So what this is telling us is that while it might not rally here to a new bullish long-term trend, the bleeding seems to be stopped. From a technical standpoint, the bleeding seems to be stopped. There's a lot of technical indicators here that have been so oversold and have actually been diverging to an extent. Here is the 10-year yield and the divergence that you see here on the RSI from extreme low levels, getting up to its highest level during this little decline, this little bounce, bottoming formation of this divergence. In fact, getting through that high point, now you would expect this to get through the equivalent high point on the index itself, and again probably gets you up into this 2.35% area. Usually, of course, that means that is bullish for stocks when yields go up. So we'll see if that ends up being the case. If you take a look at the dollar index continues to be bearish. We had that breakdown last week. It's been quiet this week, but it's been holding ground at these relatively low levels. You can see how we've broken below 50 and had a bearish peak here, and then now are easily below 50 here on the dollar index. You can see from the Ichimoku cloud standpoint also very bearish trend, easily below this band, easily below the green line, nowhere close to turning bullish at all. In fact, if you look at the market forecast, obviously the daily market forecast is bearish, dark pink shading, dark red line, right? So that's bearish. If you look at the weekly chart, you can see we're very, very close to getting, we already have the red line on the weekly 30-week moving average, and we're close to having the dark pink shading as well. And of course, that could lead, you can see to extended bearish runs or short-term bearish runs, but that's the bearish pattern that you look for. And again, that in the past, that kind of bearish move has actually been really bullish for stocks, especially international stocks, and especially emerging market stocks. Looking at the emerging markets, you can see the big names out there: Russia, China, India, all your top performing foreign markets. The S&P towards the bottom of this list, actually underperforming even ACWI. And then on the very, very bottom, you have Spain, Switzerland, Italy. There's your small cap index, France, Japan. So you have more developed markets, including the U.S., all lagging behind. Turkey and Argentina, kind of your really small cap emerging markets, so to speak, also lagging behind, along with Indonesia and Thailand. So you're kind of your bigger players. And I've mentioned this before in classes, but when emerging markets outperform, it's usually the big names. I've always compared that to college football or basketball. When a conference is strong relative to its peers, to other conferences, it's usually because its top dogs are strong. So like the SEC is strong right now because Alabama is so good. That's one of their top dogs. The Pac-12, on the other hand, is not so strong because USC is not doing as well, and that's that's probably their biggest top dog. Now Washington, Oregon, but I mean that's that's the idea behind that. The Big 12, the top dog would be University of Texas and Oklahoma. When those two are doing well, the conference is doing well relative to its peers. So when emerging markets are doing well, then it's because China and Russia are doing well, and to another extent, India or Brazil, kind of that second tier. So, and that's what we see today. And you can see a lot of bullish, a lot of green here. We got weak bearish posture in Japan. Remember, developed markets are lagging. Weak bearish here. We don't have the green line yet on Germany or UK. And India's turning back. It will be green now after today's move. You will be back to that bullish pattern. But everything else has that bullish pattern of dark green shading on the charts themselves, as well as the rising green line. Some longer than others. Russia and Brazil have been doing well, but now you're starting to get the big dogs. Right now, you're getting China coming in. You'll have Korea kind of matching what China's doing, and then you'll have India kind of breaking out of this triangle as a triangle that it's forming as well and moving higher. And those areas, if the dollar were to go into a long-term bearish move, you would have some really good opportunity after a couple of years of underperformance, or probably about a year plus of underperformance in the emerging markets, especially the bigger names in the emerging markets. If there is any kind of trade deal coming out of U.S. and China, that's China's been hit the hardest by far. In fact, if you look at its chart, here we go. Look at its chart, and let's go back a few years on that daily chart to that peak, and then put on a comparison chart. Put on a comparison chart here with the S&P 500. Then you can see from that same equivalent level where the S&P peaked as well. You can see that the S&P is currently trading not well above, but above that level, whereas China is trading well below. So there's a lot of opportunity here for this to catch up. Doesn't mean that this has to fall, because the U.S. stocks can go up too, but there's opportunity for this to catch up. And over here, the U.S. market caught up to the downside with China, with that really sharp move to the downside, and now it could be the opposite here if the dollar falls and bullish sentiment returns. Not surprising to see energy bounce back with a big strong move in crude oil. It's up 3% during the past couple of weeks. If I just look at just today alone, let's go to today here, then you can see energy started the day strong, held its gains, technology as well, and discretionary. So as bearish as today was, by the end of the day, you had some really good sector rotation here. Whereas on the other end, the weakness came from the safe haven sectors. And remember, and I've shown you this chart multiple times before, but if I were to come here and update this, this is the returns of those safe haven sectors over the past 200 days compared to all the cyclical sectors. So there's opportunity for those areas to start to underperform, and these cyclical areas, including the dollar-sensitive areas, to outperform it. And if I were to go to September the 10th on this chart to reflect that chart in graphical form, September the 10th, 18 till now, to a daily chart, there's those outperformers. So again, any weakness in the market today, at least, was actually led down by the safe haven areas. And you have opportunity for these bullish areas, and you can see only a 1.5% return for the market as a whole over that time frame. There's opportunity, especially for the dollar-sensitive areas, which have been laggards, to start to outperform themselves and reverse this, bringing these safe havens down. They don't have to come below zero, but to bring them down towards zero and get these sectors that have been below zero for 200 days back on the flip side, back to the upside. All right, so one stock that's in kind of this cyclical area, and specifically consumer discretionary, is Best Buy. Best Buy has been a stock that's been a little bit of a struggler, but you notice it's had a little bit of a bounce. Its intermediate line is crossed above 50, so dark green shading, and its moving average has turned higher today, so it's going to be green tomorrow. That's your bullish combination. We had the breakout, a little return move, and a nice little bounce up today. If you take a look at the 3 green arrow charts for Best Buy, you can see again we had one red arrow. The buyers brought it down to the underneath the upper quintile, or the upper quartile in this case, of the 14-day range. Well, we bounced back up today, and there's your third green arrow. If you take a look at the 2-line versions of this, the 8 and the 17 have crossed through the 30-day moving average and now to the upside. So there's a bullish combination there. Taking a look at some of the others, we'll look at the DMI chart for Best Buy, and you can see we've had the crossover here. So they're both below 25, and neither one of them, the blue line hasn't crossed above 25 yet, the orange line hasn't crossed below 20 yet. That's your ideal combination, but the fact that they've had a crossover while below 25 is setting us up for a potential move. And then if you look at the Bollinger Bands for Best Buy, again, here we go. Takes a second to come up. Not that symbol. There we go. You can see how we're flirting with this top end, with this point of control. We hit it, we pulled back, and now we're making another run at it from a higher low. And we'll see if that ends up breaking us here. We're still in the top half of the Bollinger Band width, trending higher, an opportunity for us to make a move towards this 75 area, 74, 75. From a long-term standpoint, Best Buy here, whoops, keep putting in that T. We're back up above that T. The 15-200-day moving average are sitting on top of each other, and they're flat, and the momentum is flat. So again, setting us up for a move, for a possible move to come out of this. So if I take a look at not the active trader, but just a regular chart here, again, I don't necessarily want to be too aggressively bullish. And we don't have necessarily this is more of a directional trade. We don't have the strongest support directly below us. So here I want to be able to keep my losses small in case this thing does tank to the downside for whatever reason, but give me a good potential reward to risk ratio if we do make a good run. And of course, buying a call option is one way to do that. I can look at buying the 68 call, but if I look at the 71 call option to reduce the cost, now instead of paying $2.17, I'm paying $1.28. And now I need the stock, which, according to its current volatility levels, between now and July expiration, it could trade up to 73.5 roughly into that area within one standard deviation. So for it to get above 71 is not out of the realm of possibility at all. Even on the chart itself, 71 is not outside of technical. Big technical ranges here. You can see we'd have to get through that high point, but we'd expect to, coming off of what would be a higher low, we'd expect to get to a higher high. And so 71 is right in this area. In fact, you're getting a little bit of an inverse head and shoulders pattern developing on this. So not out of the realm of possibility at all to make that kind of a run. And if it doesn't, I can keep, my cost, my maximum loss is $128 per spread. And I can keep it to even half of that, to about $64, knowing that if it does get above 71 and stay, then for that $64 of risk that I'll end up taking, which you can see, I get to the 64 pretty quickly, relatively quickly, and then it takes forever to get the other 64. So I'll take that first 64 and not wait for the other half to get out, because it would have to get down here to a pretty decent move, to about 65, and that would pretty much nullify that little bounce that we've had and break us through that line and break us through support. And so that would be an easy and obvious way to get out with a 50% loss. But for $64 of risk to be able to make 174, that's nearly a 3-to-1 reward to risk ratio. We'll take that for a stock that doesn't have to make that big of a move to get it. And volatility and time decay, even though I'm only 23 days away, don't have that big of a factor on it either, because they're such small numbers relative to the $128 of total risk that I have in this trade. All right, you've heard from me. Now I want to hear from you. Let's keep this conversation going in our Market Outlook forum on marketscholars.com. There's a link right there that will take you there. Post any new questions or any questions or comments you have about tonight's video in a new thread. Remember, you can always reply to anybody else's thread too. But let's have some back and forth going until tomorrow's video in our forums. Remember, you have to subscribe to our site to participate there, but you can do that for free. I showed you earlier in the video how to do that. Thanks again for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content in between videos, and join our community that we've created on Facebook as well as at marketscholars.com. As always, thanks again. Have a great rest of your evening, and we'll see you all next time.